You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. I hope you are doing well on this Wednesday. For this episode, I have to thank Ron. Ron, he is a DSR member, a longtime member, actually, followers, listeners. He's everywhere, and he just asked me about TFI International, asking me if it was an opportunity or a falling knife. So TFI is down more than 40% year to date. So a pretty tough 4 months for TFI International. In comparison, the market is down about 5% at the time of recording. So I did that on April 7th, right before the market opened. So maybe we're now, TFI is down 45 and the market is down like 10%. I'm talking about the TSX, of course, not the S&P 500. So Canadian market is a little bit better these days than the S&P 500, but nonetheless, minus 40 is a big loss to swallow, especially under just 4 months, right? The stock price is back to 22 levels. So out of like a few months, TFI shareholders just lost like about 3 years of investing returns. That's kind of crazy, right? So let's take a deeper look at the business model and how it grows, and we'll try to determine together today if it's a falling knife or a great opportunity. So first, business model. So TFI is one of the North America largest trucking and logistic companies. They have route and network in Canada, in the US, and in Mexico. They have 70% of their revenue, though, in the US. So definitely heavily focused in US. Even like during the last quarterly report, the CEO mentioned that he thought of moving its headquarters into the US, which that didn't play well with the Caisse de dépôt des placements du Québec, which is one of the largest shareholders there. So they decided to abandon the project for now, but still they pay their dividend in US as well because the bulk of their revenue is coming from there, and they have routes pretty much everywhere. Their playbook, they are offering truckload and less than truckload and logistic services transportation. So long story short, they focus on optimization. Like the better they are with their routes and the better they are with filling the less than truckload with other clients, the more money they're going to make, right? So it's a game of size. It's a game of customer diversification. It's a game of optimization. The growth vectors for TFI International, well, they have been known to grow by acquisition, actually aggressively growing by acquisition. The trucking business is a highly fragmented market. You have like a bunch of like small companies with like small fleets. And usually what happens is whenever there's a recession or an economic slowdown, a lot of like those small players will have a really tough time. And this is where TFI International comes in, like not really like a savior, but more like a shark eating like the prey easily. So growing by acquisition in that fragmented market, adding again, more numbers to their advantage, like having a wide network, having a lot of clients makes it easier to optimize everything. And of course, to fill those less than truckload shippings, right? In terms of economic moat, while we're going to talk about the fleet size and the network here, of course, it's really hard to compete with such a large business. If you have like a small like trucking fleet, you're going to be able to get contracts, but it's going to be very hard to have like large contracts such as TFI does. So that is like one thing in their advantage. It's not huge in terms of economic mode. It could easily be shaken, but still, it's one competitive advantage they have over smaller players. In terms of numbers, when you look at the 5 years growth, it's kind of crazy. You have like revenue growth over the past 5 years, 17% annualized growth rate, earnings per share at 13, dividend at 18. So we're talking about like double digit growth everywhere. However, mostly happen with the big acquisition of UPS Freight, which happened about like 3 years ago now. So since then, the dividend triangle is actually heading the other way around. So revenue and earnings are slowing down, not increasing. So see, once more, you have to be very careful when you just look at the 5 years numbers. There was a big jump after the acquisition. Now it's more of a slowdown, and we're going to get into the risk section in a minute and determining if it's a falling knife that you should avoid. But that is one thing that is happening. The fear of having an upcoming recession and the economic slowdown that we expect is not going to make 2025 a great year. So the dividend triangle is likely going to weaken again moving forward. If you are looking for companies with a strong dividend triangle, meaning companies that have this ability to increase their sales year over year and then making more profit year over year and then increasing their dividend, sharing the wealth with shareholders year over year, I compile a list that I update every month. You can download it for free at moosemarkets.com/rockstars. Once you're on the list, every month you're going to receive the updated version of the Rockstar list, including all Canadian and US stocks with a robust dividend triangle. So definitely a great place to start when you are looking to add some companies on your portfolio. Now let's talk about the business risk, because there are a lot. Shocker, the stock is highly volatile. It's not the first time that we see a big drop for TFI International. It happened in the past, like this one, 40% in 4 months is a bit heavier than usual, but a double-digit drop on earnings day, we have seen that before. The business model is highly cyclical. Whenever there's an economic slowdown, the company is also going to suffer. Of course, they have to maintain their fleet, even though they don't use it fully. So that's a big problem. And in terms of industry and market threats, well, you have a lot. Fuel costs, which probably won't be a problem in 2025, but mostly because there's an economic slowdown. So that's not going to be great. Tariff war is definitely going to hurt them. And the reason why the stock price dropped that much is actually because earnings per share dropped by about 30% last quarter. And the CEO said, well, you know what, guys? Buckle up and enjoy the ride, because that's pretty much what's going to happen for the rest of the year. So the market readjusted, right? If earnings per share drop by 30%, if you want to maintain the same PE ratio, you have to see the stock price dropping by roughly 30% as well. So now we're even lower with 40%, but you have like this kind of like perfect storm where you have like fear of a recession, bad quarter, and then a lot of uncertainties due to tariff war. Well, all that putting together, well, you have a TFI International that is not doing that well. And CEO said, you know what, it's going to be a tougher ride ahead. So it's going to be, it's going to be very hard for shareholders. We have an interesting PE ratio right now, though, because the current PE ratio is around 15. The forward PE ratio is around 12. So thinking, well, the market is still relatively overvalued in general, and now we have the chance of like picking a company with a lot of growth perspective for the long run at a cheap price could be interesting. So in conclusion, is TFI International a falling knife or an opportunity? I would start by saying that my crystal ball is a bit blurry on this one. I mean, we have a stock price that is back to the level of 2022. But when you look at the dividend triangle, earnings per share were higher in 2022 than it is right now. And it is currently heading lower. So it's not going to help. Tariff and recessions are big unknown at this point. So I would say that the quality of the business is there. It's not going to fade away. But for the short term, it's really going to be rough. So if I had TFI International in my portfolio, I would hold on to it right now. I would see how 2025 develop, knowing that the CEO was like super transparent, which is great because now you have the market readjusting the price already. They already expect a very bad year in 25. They already know that the earnings per share would be likely down 30% versus what happened in 2024. So it's already priced in. Now, the unknown, like how the tariff will evolve, how the recession will happen or not on both sides of the borders or not, all of those things, that's going to be the big volatile point. If it's better than expected, you can see the price going back up. But on the other side, if it's worse than expected, well, you can expect to lose more. So I would hold on TFI to see how it's developed, but I would be aware that and be willing to lose more money on this one because it's still in a tough spot, mostly because there are a lot of factors that we don't know where it's heading. So I hope that it's going to help you a little bit more, Ron. I wish I could have told you more about this one, but yeah, I'm a bit on the fence at this point, but I would hold if I had it in my portfolio. That's maybe if a key point I would say. All right, Moose, that's enough for today. Tomorrow we're gonna talk about tariff 1 week later, what has changed, how to manage your portfolio throughout this. So we're gonna talk about that, and until then, never forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.